Hi and Assalamualaikum. My name is Nurmadiha binti Mahmud and my metric number is 264565 and I'm from group 6. So in this video, I'll begin the presentation of comprehensive case 1 for question 4 and question 9. So I'll begin answered for the question 4 and there's two equations actually, but I will answer for the question 1. And according to paragraph 2.62 until 2.71, so explain the board's preliminary review that it should develop such proposals to require a company to disclose a description of the signages expected from the combining the operations of the acquired business with the company's business when the signages are expected to be realized, the estimate amount or range of amounts of the signages and the expected cost or range of the costs to achieve those synergies. And our comment is yes, we support the objective for the board's preliminary review related to discovering whether the companies can, at a reasonable cost, disclose such extra and useful information about the acquisitions to the investors. And the real options that we can suggest here is that through the management flexibility and accounting flexibility. Management flexibility serves the business combining plan so as to realize the expected synergies. But there are two possibilities if we use the management flexibility, which are the one that can be operated for the earnings management, and the other one is to reflect the formation of the real benefits by the new business combination that are neglected by the traditional fair value accounting. Accounting flexibility is a realization of the acquired goodwill that based on the proportional allocation of expected rents among the internal reporting units. And according to board review, that it is possibly demands a company to disclose the information in the year-end acquisition that occurs, which are details of the synergies that are expected from the joining operations. So details of the synergies expected from the joining operations may refer to the type of potential benefits gained from both of companies, such as the revenue synergies, cost synergies, as well as financial synergies and market synergies. So in order to provide such information, may assess or may not disclose thoroughly is rely on the management flexibility on such details when the acquisitions really happen. And in order to do that, it does need both companies to disclose all the necessary information that is significant to investors or user. Okay, but however, to be exactly regarding the quantitative information, which is the cost on the amount of the signages expected to be realized, it seemed to impossible to realize that the element in the goodwill is not a it is a reflection of the something realistic, but is in a residual context and accounting element, because goodwill is assessed for impairment directly by assessing the cash generating units to which it allocated. So it seems difficult to allow for a detailed upcoming monitoring of a different element in the goodwill, which this issue seems to be the reason for the user's view that reported goodwill has limited relevance. In order to acquire the sufficient and relevant information related to the amount and cost of the synergies, both have to measure the cost of the acquiring the information would not be outweighing the benefits. And our view is that we should consider whether to disclose these quantitative and description measures in management commentary or in notes to the financial statement, because we have to justify which is the more preferable and vital to ensure the reliability and the relevance of such information, not to distract other significant information. So that's all from me. I'll pass to the next presenter. Thank you.
Hi and Assalamualaikum. So I will present for my part which is question 4. Question for number 2, which is to specify that liabilities arising from financing activities and define benefit pension liabilities or major classes of liabilities. So the question is, do you agree with the board's preliminary view? Why or why not? So for our group, we agree with the board's preliminary view because the company has to disclose separately the record of such liabilities amount that was acquired as part of the business for each acquisition. Second, the company should note this information will be beneficial for investors if the information is material, and if it is probably to be readily available to the corporations, these matters are required to be recorded and measured at the date of acquisition. So I will pass to the next presenter. Thank you.
Thank you, Arin. Hi, I am Ayu Arfia Idriani Mehtimokla, 264544. I will present question 9A, which is, should the board develop proposal to remove the requirement to perform a quantitative impairment test every year? Why and why not? In our point of view, such a proposal should not be established by the board because if the provision to conduct a quantitative impairment test yearly was abolished, the decrease in strength would exceed any cost reduction as per some board members' conclusion in para 4.33a, who favors retaining the requirement. If it were done contrarily, which is to eliminate the prerequisite for a yearly impairment test, the alternative to ensure the robustness of the impairment test should be pursued. It is vital to ensure the robustness of the impairment test as the impairment test has to be conducted in the future if there is an indication of impairment. Okay. So, why would we allow the reduction of impairment test robustness if we will use it again? So we think that a system ability to avoid adjustment without changing its initial stable configuration should not be diminished. Okay. Furthermore, emphasizing on the conclusion in para 4.33b, which is a requirement was given to reintroduce amortization of goodwill. In our opinion, amortization of goodwill should not be introduced in accounting. The ISB justification to forbid the approach of goodwill amortization is that it has contributed to arbitrary accounting. Arbitrary means instead of by requirement or the intrinsic nature of something, it predicates on or assessed by personal opinion or accessibility. That means the value of amortization would be fictitious in accounting. Therefore, we conclude that the board should not establish the provision to eliminate the annual and quantitative impairment test, and amortization of goodwill should not be reintroduced. That's all from me. Thank you.
Assalamualaikum. My name is Nurul Azri dari binti Muhammad Anwar, metric number 264265. Okay, I will continue the presentation with question 9b. Okay, the question is, would such develop proposal to remove the requirement to perform a quantitative impairment test every year reduce cost significantly? Okay, my answer is yes. Okay, from paragraph 4.14 and 4.15 business combination, goodwill, disclosure of goodwill and impairment, it states that removing the annual requirement test can reduce the cost in paragraph 4.14 B and D, which is gathering inputs used in the evaluation model to determine the recoverable amount, and the internal and external review of those inputs to confirm they are reasonable and suitable. And also disclosing information about the impairment test even if no impairment loss has been recognized. Okay, based on our understanding, when the company make the annual impairment test, the company have to allocate the cost to gather and get the data information to determine the recoverable amount of the goodwill. Okay, but when we use an indicator-based impairment model, the company are not required to make those estimation as long as there is no indication of impairment of the goodwill. So even applying the model, I mean an indicator based impairment model, it will not reduce cost at initial setup and also updating valuation, but we think at least it have a reduction in cost, especially for frequency cost of the impairment test. So that's why both of costs we conclude as high cost reduction. For optional qualitative test, the extent of cost reduction is medium. Okay, in 2011, the Financial Accounting Standard Board (FASB) introduced an optional qualitative test in US GAAP for testing goodwill for impairment. So an entity that applies US GAAP has the optional to first assess qualitative factors to determine whether the value of a reporting unit is less than its carrying amount. So from the publicly survey, it shows a steady increase in the number of public companies electing to use step zero, which is from 29% in 2013 increased to 59% in 2016. So from that increasing, we can conclude that implementation could provide the cost benefit for the preparers. Okay, so it happened because under an indicator impairment model, the entity would not be required to perform the estimation of revaluation of the CGUs as long as there was no indicator of impairment of the goodwill. So for some entities where there are many CGUs in the group of CGU to which goodwill is located, relief from the annual qualitative test could provide a significant cost saving. But I conclude this optional qualitative only can reduce cost at medium due to the amount of company using the step zero not dramatically increased. So that's all from me. Thank you.
Hi, my name is Nur Kamarina binti Muhammad Kamal, and I will be presenting the last question. It asks that, in my point of view, would the proposal make the impairment test significantly less robust? Why or why not? So from my point of view, yes, the proposal can make the tests of impairment significantly less robust. It is to be said that every year, the preliminary view of the board should be developing proposal in removing the requirement to conduct an impairment test that is quantitative. Thus, if the proposal is required annually, the impairment test would be less robust as the test cannot remove the shielding effect resulting from the unrecognized headroom. A better reliance will be placed on the indicators to make sure that the robustness of the test, if the board chooses to propose an indicator-only model for testing the goodwill impairment. Providing exemptions from the required quantitative annual disability evaluation to entities could lead to cost savings for preparers. So this will help to accomplish the purpose of simplifying the accounting for goodwill by the board. The board may wish to consider requiring that the evidence and conditions that give a rise to the disability test be reported, even though they did not actually result in a failure or reversal of impairment. Few users have been commenting that the qualitative information related to trigger events can be useful during the outreach with stakeholders. Nevertheless, under limited conditions, such a move may result in a less significant disability evaluation, also the loss of some knowledge and the governance process, which few of the stakeholders would find it useful. Although the workers agree that it's possible reduction in the tests of robustness, it's not likely to be huge or significant, and that any of the other issues may be mitigated by the improved transparency criteria. The gains of conducting a quantitative impairment test on an annual basis are also reduced in relation to the cost of performing a quantitative impairment test on an annual basis. That's all from us. Thank you.